Good morning and welcome to Fast Market. It's Thursday, December 20th. I'm Tom White, joined on set by co-host of Fast Market, Kevin Hincks, and also by Scott Bauer, the CEO of Prosper Trading Academy. Welcome, guys. I think the market's trying to look for some direction, but I kind of wanted to read off a couple pieces of information before we get started. 60% of the S&P 500 companies now in bear market territory. That's 20% or more off their highs.
Okay, let's go through those. That means nothing to me.
Okay. Right, I'm with you on that, 100%.
Okay, first thing means nothing. Let's go to the next one.
The S&P 500 is down 10% this month. Dow down 9%.
That's an opportunity.
S&P 500 down 6.5% for the year.
Another opportunity.
NASDAQ having the worst month since 2008.
That's expected, but a little alarming, but another opportunity.
And U.S. stocks overall are having their worst year since 2008. And the S&P 500 has declined for 7 straight Fed days.
Yes.
Which all have had
but think about this.
Fed chair
7 of it, probably the last, how many of the last Fed days has the Fed raised rates?
Right, it's been a complete flip-flop of rhetoric.
Right.
More than half of those meetings.
Right.
Yeah.
Right.
Four times this year.
There you
so
go.
far.
So you know what this all says?
What?
This says that 2018 was the year of the unexpected.
Right.
The entire year, from early January on to now, the market has traded with no definition whatsoever, with so much uncertainty. And we have seen so many aberrations that we haven't seen over the last 8 to 10 years. Why not end it that way now?
Scott makes a great point here, Kevin. The fact that we've been, if you take a 10-year chart of the S&P 500, we went up for 9 straight years.
You know what I did today?
What?
Funny, I took a 20-year chart of the S&P 500 and looked at it.
Yeah.
It puts a little perspective into this sell-off.
And that's the whole thing. It's not the Fed's mandate to look at the equity markets and make them go up, right? We all know that. But I think investors and our viewers have to realize that this is historically a normal event where you have maybe a pullback in equities especially after that 9-year run, which is almost straight up. If you smooth out some pullbacks here or there in 2015 and 2016, early 2016, it's been straight up. So you should expect a little bit of a semblance of pullbacks occasionally. Scott, your take on that and trying to appease investors' fears at this point.
So I'm going to play psychiatrist. I'm going to be like, in the Peanuts movies when Lucy has that sign up, the psychiatrist is in. And no, seriously, in this day and age with artificial intelligence, with all the algorithmic trading out there, and the millennial sense of emotionality, meaning that they want immediacy in everything. Yeah. That's why every move in the market is so magnified.
Right.
But again, like you guys just said, when you smooth it out and actually look what happens over time, this isn't so out of the realm of where we've been.
It's nice. Right? It's good that you made that point because it gives our viewers and investors and traders out there some semblance of, hey, everything's going to be okay, but hey, we've got some volatility in this market and it might last a little bit longer, Kevin.
Right. Rob, follow me to the Thinkorswim platform. This is the 20-year monthly chart of the S&P 500 that I put up here.
Yeah.
And if you look at it like that, it's actually pretty smooth, and this move is not that crazy and out of the norm. And think about this. We're going to be down, unless we rally enormously in the next, 8 trading days?
Yeah.
We're going to be down for the year in the S&P 500 with basically, as we start looking at fourth quarter earnings, so far the first 3 quarters of the year, but between 22 and 25%
not bad
earnings growth. So it'll be interesting to see. And remember, they've completely downgraded fourth quarter's earnings now from in the 13s to now in the 12s.
Right.
So we'll see how that comes out. If they beat by the same amount that third quarter hit, it should be up around 20%.
Yeah, and I think, we'll get into the Fed discussion here in a minute, but I kind of wanted to just take the overall market in general, what expectations are for the next week, Scott. This added volatility, the VIX is up today. We're above 26, I believe, on the volatility index. Now, us as old market makers and option traders in general, we tend to gravitate towards those higher volatility levels. Do you see opportunities here from a trading standpoint and an investing standpoint?
I see lots of opportunities over the next week, 10 days. And in fact, my students this morning, we had this exact discussion. Scott, what's going to happen over the next 10 days? And my answers were, A, we're going to see volumes start dwindling a ton.
Less eyes.
Less eyes, because lots of people going on vacation. That, though, being the end of the year, people positioning themselves for taking tax loss going into 2019 presents great opportunity. Right. I'm sure you guys are in the same camp as me. When we were trading on the floor, I wanted to be on the floor in these days. As much as I wanted to be on vacation, on the beach somewhere, I wanted to be on the floor because less people were there, more opportunity.
I literally,
half the traders.
And I've told this story before on this show. I used to take a poll of the trading pit. If a lot of guys were staying, I was taking off. If a lot of guys were taking off, I was staying.
Yeah, because it allowed you to get into more positions, maybe do more size. And you guys make a good point here, and I think investors and traders and our viewers have to take note of this, is during those lower times of volume, so maybe there's not as much concentration in the markets as far as volume goes, you're going to see wider bid-ask spreads.
Totally.
On top of, and we haven't had this for a few years, added volatility in the month of December. We haven't seen that for a while, so that's also going to widen out those bid-ask spreads. So, and I think we talked about this yesterday on the show, Kevin. So as a trader or an investor, maybe you pull back your size a little bit. Maybe you stay a little bit tighter on
widen out your overall parameters for trading.
Right.
There you go.
Yeah, and those are good lessons to learn in that lower volume, maybe wider market type of environment.
And also, don't feel like you have to be a hero.
Yeah.
Right? If you like something, that's okay. It doesn't mean you're all in at one price, especially when, like you just said, Tom, you get some markets that are a little bit wider than normal. Mm-hmm. Average in a little bit, average out a little bit. Don't be a hero. Take advantage.
Scaling in and scaling out. This is an important time of the year for that.
Sure is.
Even though there's maybe some ticket charges in scaling, it still makes up for the fact that if you're averaging in, you're going to get a net better price.
Yeah, and I think the positioning of staying risk defined in this type of environment never hits home more than it does right now in this type of environment. Let's move over to economic data. So we had a couple reports today. Weekly jobless claims. A little bit higher than last week's, which was extremely
214,
low.
though, still historically low.
Right there.
Right. 4-week average, moving average dipped to 222,000 from 224.
224 and 3/4 is what it was. That's got to work its way down, obviously.
Yeah, and that's a great way to look at it. Smooth it out over a number of different data points on that. But do you take anything away? The job market's still really healthy.
The foundation of this market is still there.
Yeah.
Right? Strong labor market, starting to creep into higher earnings, but because of gasoline prices, very low inflation.
Yep, and I think we'll get some more clarity on that inflation tomorrow with that with the Fed's PCE number that comes out. But then we also had the Philly Fed. I think it took a cue from earlier this week. We saw the Empire State Manufacturing data that was a little bit lower than expected, Scott. But do you think that's maybe seasonality issues, or do you think that might be a trend starting? Because we had last December, the Philly Fed was 27.9. I know that was a robust time for the economy, and maybe it's not comparable, but that's a huge number. We slid to 9.4 this December. Do you see that picking up steam, or maybe just seasonality?
I do see that as an ongoing trend here. That being said, though, that's not necessarily a bad thing. Yeah, we want to see that number higher than that, but okay, we pulled back quite a bit. Now maybe we're getting back into the norm, and now we can build because, Kevin, like you just said, that base that's set in with these economic numbers is still pretty strong. Now maybe we can start building up from there.
The operative word in this thing, Philly Fed business outlook. Right? With everything that's gone on in the last 4 to 6 weeks, how could the outlook be better, robust, and higher? And it's not shocking that some of these forward-looking numbers just start to trail off a little bit until they see some data and some earnings in the fourth quarter.
And you make a good point. This is a survey, Kevin. This isn't exact.
It's one of those forward-looking numbers, which the fact that it's come down off its highs, not shocking at all.
Not at all, due to seasonality and maybe a slowdown. I mean, look at those GDP numbers that we had in the second and third quarter this year. Pretty robust, so not surprising that we're starting to see a little bit of a pullback in there. Leading economic data indicators were up 0.3% to 111.8 in November. Yep, I mean, you got to remember, September was a record high in this particular number, and we haven't pulled back that much. So that's still saying that the economy is relatively healthy.
See, what I like about that number that you just gave, up 0.3, the expectations were for unchanged.
Yeah.
So what's happening to this market? just like the earnings growth. All the expectations are starting to come down, but the actual numbers aren't.
Yeah. Okay, so let's pivot. We've got through the data. I think tomorrow is what we're really going to focus on as far as data goes. GDP, durable goods orders, consumer sentiment. We'll have to see if those numbers pull back a little bit with this crick in the market that we've seen. But Scott, we had the FOMC meeting. We've talked ad nauseum about this and what happened during that event. What was your biggest takeaway from Fed Chair Powell's press conference and the fact that they raised a quarter of a point?
Well, the fact that they stood fast in the independence of the Fed versus the political side of things. Okay, I don't think there was any chance that they weren't going to raise rates, because if they didn't, I actually see that as a major bearish signal if they would have not raised rates.
Right.
Okay. So did he deliver on what, quote unquote, the analysts, the people wanted to hear? No, maybe he didn't, but the message, I believe in the long run, is the right message.
Yep.
And I am a firm believer that the Fed has done a fantastic job, at least in my adult trading career, navigating the markets, having the foresight to really anticipate what's going on. Have there been hiccups along the way? Yes.
Yep.
But I certainly have confidence in them, and I see it as what they had to do.
Yeah, and Scott makes a good point. For the most part, they're doing what they're elected to do, basically, right? And that's create monetary policy for what's going on. A lot of people said that they were behind the curve as far as the rate hikes in 2015, 2016. We didn't see a lot. I think they predicted 3 in 2016. We got 1.
Right.
So they were behind the curve, according to a lot of people, because they saw this growth coming. But Kevin, one key point that I wanted to make on the comments out of Fed Chair Powell was, policy does not need to be accommodative at this point. So what's he saying and that's when the market turned around and went extremely negative. We dove into the red after that statement was there. He's telling you that the economy is still doing well.
Yes. So why I believe that this market really overreacted to what he said. They took the headline, he raised rates because what had worked its way into the expectations, that he wasn't going to raise rates.
Right.
I think the probabilities came down,
Yeah.
but there was never a chance he wasn't going to raise rates.
Yeah,
because what Scott just said, it would have sent the signal that the economy was
is weakening.
If you looked at his opening sentence in his statement, the economy is strong and on a steady path.
Yeah. And
he said it, right? But here's what I think. If we were talking about nothing else, remove all the other data from your minds. He projected a 2.3 GDP and a 3.7% unemployment rate. Sound like a weak economy to you?
No, and they expect that unemployment rate. They expect that unemployment rate to drop towards 3.5% over the next 6 months.
So real data versus expectations. It's always a fun thing to look at.
But I want to bring up this one point, because the Fed misses the boat. They're always lagging, it seems like, as far as cutting rates and hiking rates, right? So with their rhetoric saying that the economy is still really healthy, when you had all these economists and market watchers coming out, the week before saying, hey, the Fed shouldn't hike, you've got a lot of people saying that, but the Fed looks at the data, and they're data dependent, right?
Right.
And they're saying, hey, no, the economy's doing okay. We haven't seen, the slowdown over in Europe and China taking hold here in the U.S. We're going to go about our business like we said. Now, they did predict only 2 rate hikes in 2019 instead of the 3 that they had mandated before.
Right.
So they're coming down, but they weren't as uber dovish as a lot of people thought, and I think that's what hit the market.
That was the key. That was the sentiment coming out of it, and that's the continuing negative sentiment overall in this marketplace right now, and that's how people interpreted it. Again, I'm still a firm believer in the Fed, in the people that are in place there, and until they really do something wrong, which I haven't seen yet, I got to believe in them.
Yeah, and I think as we get more data, tomorrow will be a big day, but like Kevin said, pinpointing next quarter's earnings season, because these forecasts and guidance going into 2019, I think, are going to be really key, because the latter stages of this earnings season, including FedEx the other day, we saw what happened with Adobe. We saw some other companies saying, hey, we're starting to see signs of slowdown. And we'll see it first, right?
Right.
By lowering our guidance, and then the Fed will come in after that. Do you see that becoming a catalyst.
That dot plot going from 3 rates to 2, that's the average, right? Several FOMC members came in with none. Yep. So, and remember, him saying they're going to be data dependent and the average being 2, it could easily be none or 1 next year, easily.
Yeah, and that's going to be data dependent, right? If we see that big, massive slowdown that a lot of people are predicting into the middle of 2019, maybe they do pull back and say, okay, now we're going to become more accommodative.
And if muted inflation keeps showing its head, there's going to be no reason for him to act on low inflation.
Yeah, you make a good point there. Go ahead, Scott.
You know what will happen if that's the case? You're going to get all these pundits and all these economists saying, I told you so, right? We never should have raised, this, that, and the other. But again, you have to have belief in our system. You just have to.
And it's not only... And Kevin and I hit on this all the time. The economic data has really been good, and we're starting to see those pullbacks. All the data points I gave you over the last month for the S&P 500, the NASDAQ, and the overall equity market.
And one last thing, for all of our viewers that are out there, when you are listening to a pundit talk about interest rates and the Fed, just make sure, I'm not a cynical person, but make sure that they're not talking their book.
Yeah.
Jamie Dimon talking about 4.5% 10-year yield, he's talking his book. Gunlett, who was on the other day, they're all talking their book.
He's a bond guy, right?
Right, he's a bond guy. So discount someone who may have something in the game for that direction.
Now
You've got to discount that.
You make a good point. You've got to take into consideration what their business is.
Right.
But at the same time, they bring up good points about the economy too, and some of the data that they look at going into their comments that they make.
The President of the United States talking about he wants lower interest rates. Okay, every single President of the United States, no one, Alan Greenspan said this in an interview, no president has ever called for higher interest rates in the history of
the Fed. And he's a real estate guy.
Right, and he's talking his book. Yeah. Exactly.
He's talking his business that he was a part of. I get that. Okay, guys, let's move over to, as if we're talking about inflation and lower inflation, and that PCE number that we're looking forward to tomorrow that the Fed follows so closely. Oil, Kevin, down another 3.6% today.
Amazing.
Hit 17-month lows overnight. I think the low was about 45.82, Kevin, on oil. First time since August of 2017 that we hit those lows. Your take on oil and...
There it is, 45.82.
Production cuts don't matter, it seems like, to crude oil.
You know, a very smart person told me one time that trades futures. Futures will go where they can hurt the most people, right? And futures get overdone on one side. You saw it when they thought inventories were going to be light. You saw oil go into the mid to high 70s. It'll go a little further than you think every time.
I mean, we went into
just when you think oil's on the lows, it isn't. Or the highs, it isn't.
Yeah, remember it was under $40 a barrel, right?
That's exactly why those wings in commodities, and especially oil, those wings when you're trading are so expensive.
Yeah.
Because of those big outlying, the potential of those big outlying moves.
Yeah, you make a good point there, Scott. And Rob, if you follow Kevin to the
This is a 3-year weekly.
3-year weekly chart in crude oil.
It can't go lower. Yes, it can.
Yes, it can.
Yes,
and that's the point. Commodities, it's one of those products, and Scott and Kevin and I have talked about this over the last week, is commodities trade. They're risky, they're risky instruments.
And there's a seasonal factor with commodities that has to be brought in. There's a lot of nuances to trading commodities that don't show up in other trades.
Yeah, and that's why, at TD Ameritrade, that one of the levels to be able to trade futures is the highest level that we have due to that inherent risk.
Well, we always say, Tom, it's got to be a little more attentive. You got to know the dates when futures go off. You got to know, you got to pay attention to open interest, right? When futures start getting low in open interest, they get a little more volatile. You got to move, keep moving ahead of those dates.
Got to be very, very reactionary. You got to be right on top of it.
Yeah, you know what? You guys make good points, because as we look at equities, individual equities, what are we looking at? We're looking at any updates on their corporate results, right? Earnings, all those data points, and the same thing goes for futures. But I think you have to also look at the headline news in a lot of those commodities. And
a lot of it's news. You got to deal with rumors all the time. I mean, there's just a lot of things to sift through. It's a very studious trade, but it's a fun trade.
Yeah. So we have the production cut upcoming from the OPEC and the OPEC Plus nations of 1.2 million barrels. What are we looking at when you're a trader and you've seen this massive, I believe it's about a 37% downturn in the last, since the start of October 5th, I think, is when we started turning lower. What do you look at when you look at oil and the massive slide that we've seen, Scott?
So on a day-to-day basis, you're keeping it really close to the vest, right? You're playing whatever sort of ebb and flow that you can on a day-to-day basis. On a longer-term basis here, I think you can afford to take a little bit bigger positions, whether that's on the up or downside. I think you can do that because of the big intraday volatility that we're seeing. Now, that being said, I'm running out to my gas station. I've got thousands of those 2-gallon, portable containers to fill up for my snowblower.
$2.01
Oh my.
in the west suburbs of Chicago.
I'll lock myself in for life at $2 a gallon.
Exactly.
Yeah. And I was telling Kevin before we came on the show, I asked him, I go, what did you pay for gas out there?
Sunday
in the
night.
suburbs of Chicago, and I'm in the city, and I paid $2.85. I was kind of bummed out.
Well, it's cheaper where I live up a little bit further north. My taxes are even lower, so I'm about $1.90 right now.
That is
And Kevin and I talk about the effect of lower fuel prices. It's a tax break for a consumer, right?
Sure is.
Going into the biggest consumer spending
Why do you think
season.
that consumer price index came out unchanged, right? Yep. A lot of the inputs were higher, but gasoline was down 4.2%.
I mean, think about it logically. Again, that sentiment or that emotion. You go to the gas station and you're used to spending $50-$55, and now you're only paying $30 to $35. You walked out of there and you have an extra $20 in your pocket to go get dinner, to do whatever, and that is the feeling out there.
Discretionary spending goes up, right?
$52 to fill the tank. Now it's $32. Yep. Think about that. That's huge. 40% lower.
And also, what's helping the consumer recently is that pull down in yields. Also, credit card debt, things like that, buying cars, houses, interest rates. All right, guys, let's look at the trade page here. And
are we going to go where we rarely go?
Yeah, Kevin's going to
curvature. We're going to back spread.
So go ahead, Kevin. Walk us through that.
First and foremost, how you would do this is pick the direction that you think the underlying is going to go, and you want to be long or short that way. If you think oil's going down, you want to be short the future. If you don't think it's going up, you want to be long the future, because that underlying will outperform options most of the time.
Okay.
Right? More than
historically
a large percentage.
Has, yes.
Right. So what we'll do is, because we're only, we have to move out here a little bit on the scale, and what we want to do is trade some. Do we want to trade 27 days out? Is that too much or too little?
I think it's okay. Okay. 27 days to February futures expiration. Yeah.
And you can see that's the February contract. That's the front month. It's the most active. So what we'll do is here, we will go to the ask, and we will buy how many, Tom? 5?
5. That's fine.
Let's buy 5 crude oil futures. Okay. And we'll send that in.
So now against that,
we are now long crude oil. Okay. And now against that, what we're going to do is we're going to go to the at the money, about the 50 delta. How about something around the 46 level?
Yeah, we can do that.
And we're going to buy 10 of those. So we're going to be long futures, long puts.
Long puts.
Synthetically, for all you option traders here, if you look at the mathematical equation of that, long future, long put, long stock, long put, that equals long call.
Right.
That is an upside position.
And
importantly,
and really what synthetically is you're long the straddle.
Right. Exactly.
Because you outright bought 10 puts, and then you synthetically bought 10 calls. And so there's the graph of what you have. Now that's 5 futures versus 10 puts, and you can see we're a little bit long. Right? Because we bought a put below where the underlying's trading right now, so it leaves us a little bit long deltas. But look at our little gamma that we've got to trade here. We've got a little long curvature.
So now the volatility that we've seen in the crude market, this type of position takes advantage of that, because you're long gamma, which actually increases or decreases your delta based on where the underlying's moving.
Watch this. What happens? What's your delta? Everyone, look at this delta right here that's now 480. If crude oil were to go right to $48. Right. Now you're long 1,500 deltas in crude oil, and you've got a little profits. So what you're playing for in a curvature like this, remember all the times you've been short some volatility, and like, who makes money in these big moves? These positions.
These positions, back spreads.
The opposite of what you had on.
Yeah, anything to add on this one, Scott, before you wrap it up?
I like it a lot, but Kevin, I thought you were going to go in and buy futures and buy the calls instead of the puts and have the Texas hedge on there.
and that's the other side.
Hey, come
of
on,
that
we're trying to
trade.
teach good practices here.
The double up Texas
That's
hedge,
right.
where you're taking both positions both ways, or as we like to call it in the options market, we used to call those if you bought two options instead of bought one and sold one. It's a stupid.
I can say I've never had that on a lot.
Till yesterday.
Yeah.
All right.
Yesterday.
So Kevin's got that in, and we'll go ahead and follow that as we get through these moves in crude oil over the next month. Scott Bauer is going to join us in the D block later on, but coming up next we have Face Off with Ken Rose. He's going to join us to break down Nike ahead of their earnings tonight after the close. Stay right here on the TD Ameritrade Network. Fast Market will be right back.